You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. It is a dangerous world out there. Volatility is on the rise, and your clients' portfolios are under assault from a growing number of threats. Simple diversification is no longer enough to shield the assets under your protection. Registered investment advisors, financial planners, and asset managers need a new weapon in their war on risk. Welcome to the Advisor's Option, the program designed to arm busy advisors with the information necessary to properly manage risk in this volatile environment. From options education, trading strategies and tips, to industry news and interviews, you'll find it all on the Advisor's Option. The Advisor's Option is brought to you by the Options Industry Council. The OIC was created to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. For more information on how the OIC can help you implement options in your practice, please visit optionseducation.org. The Advisor's Option is also brought to you by SWAN Global Investments. Since 1997, SWAN has been the leader in hedged equity and option income strategies with GIPS verified results. SWAN provides unique and valuable solutions to the inherent weaknesses of asset allocation, offering defined risk strategies that allow upside participation while also protecting advisors and investors against market risk. For more information about our advisor program for separately managed accounts, SWAN defined risk mutual funds, or our proprietary option overlay strategies, please contact Randy Swan at swanglobalinvestments.com. Think outside the style box. Think SWAN when deciding on risk management solutions to market risk. The Advisor's Option is also brought to you by Option Research and Technology Services. ORATS is your source for options backtesting. It's where you turn your ideas into results. Founded on the floor of the CBOE over 2 decades ago, ORATS is a full-service option research firm focused on helping you develop options strategies in line with your investment objectives. With a state-of-the-art backtesting platform, scanning, and implementation tools, ORATS offers end-to-end option strategy development, making the whole options trading process easier. For information about backtesting, scanning options data, including dividends and earnings, visit orats.com or email Matt Amberson at matt@orats.com. And now, it's time to learn how to implement options in your practice. It's time for the Advisor's Option.
All right, everybody. That music means it is time once again for the Advisor's Option, the program for you out there, the busy financial advisor or asset manager. Maybe you're using options already in your practice. Maybe you want to learn how to dip your toes into those options waters. Well, we got you covered. Maybe you're looking for a financial advisor and you want to know what skills they should bring to the table from an options perspective. Either way, we got you covered here on the Advisor's Option. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the network upon which you're listening to this fine program right now. If you just like A.O., hey, we like you. B, you're missing out on a whole fun network worth of shows, about a dozen of them out there for you to sink your teeth into. When we're not recording Advisor's Option, we're hitting you with something else pretty much every day here on the network. So head on over, subscribe. And if you like what you're hearing, leave a review on your platform of choice, your iTunes, your Stitchers, your Spotifys, wherever you get the program, so it can continue to help new people discover this content. In these times, perhaps more than ever, it is important for people to have a sane source of financial content out there. And so we're glad to see so many of you are discovering this program and indeed the network. We want to keep that flow coming. So keep those reviews coming. Keep those questions coming too. We do love to hear from you guys. And joining me on the program today, first, let's go out to, let's start off in the, who knows where he is. He's somewhere east of me. Could be south, could be north, could be throw a dart. Maybe he's in the North Pole. I guess we'll find out now because he's a traveling man, Mr. Eric Cott, the Director of Advisor Education over there at the OIC. Mr. Cott, welcome back to the Advisor's Option Program. I think this is your third episode in a row now, sir. To what do we owe the honor?
Well, it is a pleasure, Mark. And again, I think about all the shows that you put on throughout the week, and I'm trying to figure out what the delta is, how much sleep you get a night, because there can't be a lot with all that you're doing.
Zero, baby.
You got all the, yeah, I know. This is a 24/7, and it's always a pleasure to be with my colleagues, Matt and Chris. I think that what we're delivering in this show is consistency to the advisors. So with all of this going on, Mark, all of the chaos, the uncertainty within the markets going all over the place, this show I think is comforting for the advisor community out there to kind of pick up ideas, but also maybe refresh their minds about those strategies.
Refreshing dose of comfort food, chicken soup for the advisor's soul out there, and perhaps a little bit of the old brain matter as well. And also joining us, let's dial that handle all the way up at the clock, all the way up and around to the far hinterlands of New Hampshire, going past all the way up to Maine, but not quite that far. Getting up to New Hampshire, where we are joined once again by Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. Mr. Amberson, welcome back to the program to you as well.
Great to be here. The year's halfway over, and that's I measure the show. How much of my life is passing, Mark?
Yes, you sound like the director of risk. We haven't even gotten to him here. You're already talking about the ongoing encroachment of death. But yeah, this year has just flown by. It's been a fun one, huh? Just a party nonstop since January. Wouldn't you concur, sir?
Love it. It's been great. We had a blow off top at the close here in the market, and it's almost like nothing happened this whole year.
It's like nothing happened at all. We'll get to that. But first, let me welcome in the one who always welcomes the looming specter of death. He is the Director of Risk himself, Mr. Chris Hausman, also known as a portfolio manager over there at SWAN Global Investments. Mr. Director of Risk, welcome back to the program to you as well, sir.
Thank you very much. Happy summer. You guys are not sparing me already, attacking even before I have a chance to speak, but I've got 42 minutes to make up for it.
You got some time to make up for it. Is this summer? I haven't even noticed. We've all been isolated for so long. It's hard to tell the change of the seasons, but it is time for the change of the show. Right on into The Buzz.
Busy financial advisors and asset managers don't have time to follow the latest developments from the world of options, so we do it for you. It's time to get the buzz.
All right, everybody, welcome to The Buzz. The Buzz used to be kind of a shorter, quick segment on the show, but as I've said many times before this year, every month is pretty much a new, unprecedented, historic month. So The Buzz is taking on a different shape, a different form these days, because there's so much for us to sink our teeth into just in this one segment. I mean, again, it sounds like a cliche. I say it every episode, but this past month, we've seen things that we have never seen before. Coming into the showtime, we said for a while there at the beginning of the year, if there was a sell-off and there was a recovery, it'd be the mother of all V-shaped recoveries. That's pretty much what we saw. In fact, as of recording this towards the end of June, both the Dow and the S&P are on pace to put in their best quarters in over 20 years. And the NASDAQ having its best quarter since 2001, so a little bit shorter, but pretty darn close for the NASDAQ as well. Of course, there was a little bit of fade this week as we saw some of the lingering fears of the coronavirus make their way back in, seeing the market sell off a little bit. But again, come into showtime, yet again, broken record, rinse and repeat. All the major indices pretty much up and firmly in the green today. Only the Dow is not up a full percent. Everything else up well over percent. NASDAQ closing in on 2%. Our old friend VIX Cash, after having remained relatively firm and hovering in the mid-30s to higher for the better part of the last week and change, and certainly for the better part since our last show, it seemed like impossible to break the 30 handle. Now is hovering right about at that 30 handle right now, so we'll see if it breaks it towards the end of the show. But a lot to unpack. Let's go back around the horn, the opposite of the way we came. Let's start with the Director of Risk. Mr. Director of Risk, a lot to unpack here. A lot has happened over the past month. The vol, the sell-off, the V-shaped rally, then maybe some of the fading of that rally, then maybe today, at least not so much. What's your take on what we've all seen unfold in the marketplace since the last time we all gathered together, sir?
Yeah, it has been interesting. Since the March 23rd low, every rally has been, there's been a subsequent sell-off of approximately 150 to 200 handles in the S&P 500. And those sell-offs have only lasted just a few short days. So you continue to have this pattern of higher lows. And you got to trade that pattern until it's broken. I think the interesting thing is we have set a range here lately. I'm going to call the range 29.5 to 32.5. But yeah, I think sellers are going to hit that 3,200. We've got an island reversal formation that happened the other days, which is pretty rare. That's kind of bearish. So I think what's happening over the last few days, we're going to rally back up. We're close to the 20-day moving average. Probably rally back up to that 3,200 area, which would be a good place to enter into new shorts. I think the reality right now is we're going to be plus or minus 200 points around the 200-day moving average, which is 30.20. And subsequently, the last few days or the last week, we had a pretty good battle with that 200-day moving average. There were 3 days where we tested it. We even closed below it. But the last couple of days we've recovered. So I would keep an eye on the 200-day moving average. And I right now I'd be plus or minus 200 handles at. Sell deltas at 3,200, buy deltas around 2,800 until that pattern is broken. But that being said, remember we did have a day that we were down 6%. So there's still some, there's still news floating around. There's still some unknowns. So I would definitely still be sticking with limited risk type strategies just in case you have those days and it does materialize into something bigger right now.
Yeah, we've all seen it. When the bottom falls out, it just goes. And then the other days, like today, when even Powell and Mnuchin can't talk down the market. They're talking about a dire outlook for the economy, and the market could care less. We're back in, I've called it before, maybe seemingly again, the whistling past the graveyard mode. Pay no attention to that coronavirus in the corner over there. Matt, you were kind of an early harbinger of doom for the economy here. Going back to early January, you thought this really had some teeth and some legs, at least from an overall vol perspective, and that usually spells dire consequences for overall market valuation. Now we're once again find ourselves in this rarefied air, Matt, where we're at record levels once again in most of the major indices, best quarter in 20 years, and yet there's still just tons of lingering concerns out there. So I'm curious, what are your thoughts on all that's transpired since we last gathered here together, sir?
Yeah, Mark, I started in September partnering with the OIC at a conference and said the market had a tailwind. And then all the way up until January, I was interviewed by Reuters and said, listen, this coronavirus looks very ugly. I think there's going to be a major sell-off. The option volatility indicators that we watch were already starting to go off. Who knows what that was from? Maybe the people that knew beforehand. They were trading in the market, and then a couple of weeks later, the whole thing fell out. And then it looked like at the very bottom, we hit some major bogeys. The market width in terms of volatility was as wide as I've ever seen it. Volatility got up to 2008 highs, and we started to say this is probably capitulation, and it was. And then it rallied up, and I said, okay, well, usually we get another leg, and we just haven't seen that other leg. We got a little bit a few weeks, or when was that, the 11th, when the market just fell out of bed. But then, it just strengthened up, and they put more Fed liquidity in, and it's just floating and floating. We're just floating on air now, Mark. And, who knows what's going on. But, my market, my indicators are they're mellowing out. A lot of the fear is coming out of the market, even though the VIX is still quite high by historical standards. But like the contango numbers I look at, how wide the markets are that the market makers are making is tightening back up. It just seems like a lot of the fear is coming out, Mark.
Yeah, it's just, again, this rarefied time here where we've talked about it before. It seems like there are so many things out there to derail the broad economy. If for some reason in the near future, we do find that this corona thing is somehow in the rearview mirror, there's a treatment, and the rally continues, then how can you not buy this thing at that point? Because the trade war couldn't derail it. Global pandemic couldn't derail it, at least not for very long. This bull has proven to be unstoppable, unless, of course, this much foreseen, much hyped next wave. We have seen, of course, a lot of states that have reopened of late here in the U.S. starting to maybe reconsider that. Europe saying they're not going to let Americans into Europe when such things are possible again. So a lot to still unpack. We're not out of the woods by a long shot here, but still this bull has proved remarkably resilient here. The matador keeps plunging the swords in, and the bull just shucks him off. Couldn't care less. Mr. COTT, I turn now to you. Of course, all of this volatility in the space usually equates to interesting nuggets on the volume front. What have you guys been seeing out there for last month, for the May? And then if you got any insights on what you're expecting for June, have at it as well, sir.
Well, I'll give a little insight. I know to my friend Matt there in New Hampshire, he talked about June 11th and stuff. Well, a week ago today, I got closer to my AARP membership. Let's just say I'm not going to tell people my age, but last Tuesday was a birthday for me. And I guess early bird specials and maybe going to bed early are more in the cards for me. That'll give your listeners an idea of how old I am. But as far as volumes go and the discussions here, look, as a lot of your listeners know, I work for the world's largest equity derivatives clearing organization, the OCC, the Option Clearing Corporation, cleared in May, and I believe we hadn't had all of the data, but in May, volume was up over 17% versus a year ago, 545 million contracts cleared. And for your listeners that were keeping score, they probably remember that in March, we had a total cleared contract volume of 670 million, which was roughly about 63% higher year over year, and that was for us the highest ever volume month. And our colleague in June here, Mark, Chris, and Matt, we know Henry Schwartz, who's now an employee of CBOE, was talking, I think yesterday or today, about first quarter, second quarter volume, approximately 1.7 billion, and combining, first and second quarter estimates going into the end of this year, Mark, we could potentially be roughly 30% higher than our all-time volume, which was in 2018. So we could be, somewhere in that $6 billion range. So with all of the volatility, and Matt and Chris talking about. Again, there are definitely signs that are going on in in the economy and what's going on in the country. Clearly, institutions, retail, but obviously the advisor community that's listening today, they have realized the value of options, and across the board, we're seeing just higher volumes, across individual equity and ETFs, Mark.
Well, everyone's getting into the options volume train. The Journal writing up an article not that long before showtime here. I like the title, Free Trades Jackpot Dreams lure small investors to options. We've all seen anecdotally, we obviously engage a lot of different brokers here on the network on a regular basis, and we're hearing a lot of great things from most of them, that trading volume is up, darts are up, people are actually out there actively engaging with the market. We, of course, see it anecdotally here as well. The demand for our content has never been greater, which we're, of course, thankful for, and not the environment anyone wanted for this, but still an interesting silver lining to all this madness out there. And this Journal piece breaking down how the coronavirus pandemic has fed investors' appetites for volatility trading, and how cheap commissions, including zero-cost places like Robinhood, are starting to fuel a lot of people to get into the option space. Are you hearing that anecdotally as well, Eric, from the folks over there at OCC? Is it kind of a 1-2 punch of course, a little bit more vol, people being stuck at home, and also the fact that commissions are so low are really driving this influx, this new wave of options traders, Eric?
I think for that self-directed, Mark, and Chris and Matt might want to add a little bit to it, but I do believe that the folks that are at home, I mean, I have a 25-year-old daughter. I can't tell you that she's doing this right now, but I think maybe her boyfriend or somebody else have gotten a self-directed account, and I'm not quite sure at what firm. But there is absolutely an interest, and I think, that goes back to, Mark, the whole principles behind OIC about providing education. But I do hear a lot more. And, one of the things that I have heard from a number of advisors, Mark, is that the elder clients that they have that, they've been managing money for decades for are starting to ask them about maybe their grandkids who are now millennials getting interested in the market. And I think that's really exciting. So, maybe the other guys have a little bit more they wanted to add to that, but definitely I think we're seeing, some more people, enter the arena, so to speak.
Hey, Eric, remember our discussion at the Option Industry Conference? And I don't know if you saw Henry's graph, but Gatsby was on there. So I thought that was really interesting, along with, Robinhood and Webull. So a lot of fun out there. A lot of people. We're actually getting a lot more calls from individuals to help them, test certain strategies. So it's been quite interesting, Mark.
I like it.
Yeah, I have to say, Mark, that, I'll give credit to Matt, which I really want to, and because, having the good fortune of hosting a panel there in Miami a couple of years ago, that really was on the cutting edge, to talk about these businesses, including Matt's at Orats and Gatsby and others, and, Tony Zhang, where, these entrepreneurs were seeing opportunities. And now here we are in 2020 where, Matt talks about it, where people are looking at technology and looking at, some of the historical technical data that is going to potentially give them, some extra information that will allow them to make decisions on where the markets are and, kind of what strategies they want to deploy.
I'm still shocked, Eric. You said you have a 25-year-old daughter. How's that possible? You're only like 29 yourself, sir. It doesn't seem to be physically possible.
You're kind on the show.
Physically possible at all. Your 25-year-old. I can't even process that myself over there. Let's see what our audience is processing as well. I usually like to save the questions for the end, but this one snuck in because it is so relevant here. And you once again, Mr. Director of Risk, you're getting called out by our listeners in a good way. Our listeners liked the Director of Risk. Of course, a big story since the last time we did our show is the return of the trading floor, in particular a product that is near and dear to a lot of the hearts of this audience, which is, of course, the SPX, one of the storied legacy floor trading products. CBOE getting delayed a little bit on the return by an extra week, of course, due to all the protests going on here in Chicago that kind of engulfed the downtown area. But now the SPX and VIX are back, and a lot of interesting things to unpack there. Our listener, Mike P., wants to know, is Chris, a.k.a. the Director of Risk, able to get more size done now that the SPX pit is back in action? Also, in the interim, was he able to use SPY options to offset any of his, I almost said doctors, his DRS, you wrote it all lowercase, his DRS hedging needs? Maybe your doctor needs to hedge too. I don't know, Mr. Director of Risk. So what do you have to say here? First off, your general thoughts on what you've maybe been seeing since the return of the S, and then B, as Mike wants to know here, has it impacted the size you can get done going forward?
Well, you know what? I'm going to give kudos to the exchanges that they did a pretty good job providing liquidity in these larger products. It may have taken, you had to be maybe a little bit more patient. Right? We didn't have direct access to a pit because it wasn't there, and thank goodness that they've returned. And maybe spreads were a little bit wider, but the volume and the liquidity was there. And like Matt mentioned earlier, we have seen spreads kind of come in a little bit. For me, it seems like it's pretty much back to normal for the most part. As far as using spiders, we do use spiders. We didn't necessarily change from SPX to spiders, but it's really, some of our larger accounts that can take the larger unit size in the SPX is how we delineate between whether we're using SPX contracts or spider contracts. So some of the smaller accounts will use SPY versus the larger accounts using SPX. But we were not ever forced to give up on SPX trading because the bid asks were that wide, or we couldn't find liquidity out there. So it's a good question.
That's good to hear, because that was the fear, obviously, when electronic, because the S has never been electronic, all electronic at least before, let alone the entire industry, even the Eurodollars. So a lot of people, myself included, thought there would be a lot of dire consequences to that. I'm glad to hear, and it sounds like Mike P. is as well, that you were able to get your stuff done. Doesn't seem like there was huge SPY crossover yet. There's a lot of issues in terms of getting size done there, and also, of course, the tax treatment a little bit different. But still, interesting stuff nonetheless. Speaking of interesting stuff, Mr. Matt, I can always count on you for a deep dive into an interesting topic, usually volatility related. And these days, I know you've been pretty active over there on the ORATS blog. I guess it's hard to believe, listeners, when he's not talking on this show, he's actually cranking out content over there at orats.com. Check it out, ORATS.com, if you haven't done so already. Mr. Matt, you have an interesting blog up there these days talking about what you're seeing on the vol surface. You kind of touched on it a little bit earlier, but let's go a little bit deeper. And then if folks want to check out the blog for themselves, they can. What's been catching your eye on your various vol surface models you've been watching since the last time we chatted?
Yeah, Mark, it has been interesting. We have a lot of good feedback from the blogs we put out, especially this one on the SKU. People have come to us. We're starting to do more consulting. So we're doing things like what strategies to trade when the slope is steep, when there's a lot of curvature. How do you do the butterfly and to take advantage of that? So we've been having some very interesting conversations here at ORATS about these types of things. So I thought it was a good time to bring it up. So, we're on a podcast, so I'm going to describe it. But, most of the time the puts, the small strikes are a higher volatility than the higher strikes, and then there's also a little bit of curvature to it. There's not as much curvature in the SPX as other types of ETFs and stocks, but that's the kind of the view of it. So we draw a straight line through it, call that slope. We know it's negative, but we communicate it as positive, and then we're able to show that historically, and we also do forecasts of it. So we try to find what are the most important predictors of slope. So that's one of the things that we put out there is forecast and the actual slope. And when you're doing these are called risk reversals or verticals, you want to pay attention to how steep the slope is, because if it flattens out, there's that extra amount of risk. A lot of people know the risks of Vega and the risks of theta, but there's also a slope risk. So if you have a vertical on and the slope changes, that could either help you or hurt you. So we're watching that, and we're predicting that. We're showing what the percentile is of that. So we're looking at that a lot like you'd look at just volatility in general. And I spoke a little bit of just the curvature, like how much smile is in there. There's that kind of smirk shape, but how much smile is to it. There are some more sophisticated. That's kind of the second derivative. So that there's some more sophisticated strategies that you could get involved with on that. And then once you draw all those lines, then you could actually take and use all that and see where it crosses the 50 delta, and you get a much better at the money implied volatility. And then once you have those, you could do things like forward volatilities and just saying what the constant maturity volatilities are. So, Mark, thanks. I just wanted to give a brief overview of ways that you could look at the relationships between the implied volatilities of the strikes and, do things around it. We could throw those in our back tester and say, hey, should we trade this vertical when the skew is steep? And if so, when is a good time to get out, Mark?
Well, Mr. Director of Risk, I know you live on that vol surface as well, hedging in the back portion, harvesting some premium in the front portion. What do you have to say here about Mr. Option Rats' thoughts on the vol surface, sir?
Yeah, it's excellent because most people don't get past the first tier Greeks, Delta, Theta, Vega, maybe Gamma. Maybe they get into a little row, right? But past that, the two largest ones are a skew risk, a skew Greek, as well as a term structure. So, if you're trading wide verticals, risk reversals, risk conversions, things like that, I've had many conversations with people. Well, stock didn't move, vol didn't move, but I lost money or I made money. They didn't figure out, they were not able to quantify that. And that's really the shifts in skew. So that's very important to know. And then if you are doing strategies that involve multiple months. Well, the next biggest one that people don't have a really good grasp on is term structure risk. So it's not just about delta, vega, little theta once in a while here, but you also have to keep in mind, skew risk and term structure risk when you're trying to create the optimal option strategy given market conditions.
The dreaded second order Greeks. We'll have to have a whole other show devoted just to those. That'll really scare the heck out of everybody. We've done that a few times on a few other programs, and it's usually pretty intimidating. But maybe we can go down those deep, deep waters sometime. In the meantime, though, we'll tweet out the link if we haven't done so already during the show. Check it out, listeners. You can see Matt's blog for yourself. Since we're talking the vol space, the vol marketplace as a whole got a big shakeup since our last episode, listeners. If you played it all in the vol space, maybe you play on VIX options or VIX futures, maybe you got out to some of the other ones you talk about in vol views like spikes, or maybe you play in a lot of the vol ETPs like your VXXs and, of course, your TVIX, another big one out there. Well, if you played in the latter there, then your trading options, pun intended, got a little more limited over this past week because Credit Suisse deciding to get the heck out of Dodge on all of their levered ETNs. So not just TVIX. TVIX was kind of the lead on that story, but they got out of all of them. So their 3x long gold ETN, which was UGLD, 3x long silver ETN, USLV, 3x inverse gold ETN, DGLD, their 3x inverse silver ETN, you can see where I'm going with this one, DSLV probably, 3x long nat gas, that's UGAS, 3x inverse nat gas, that was DGAS, the daily inverse, easier for me to say, medium term ETN, of course, ZIV, which we've touched on a few times on vol views, and of course everyone's favorite out there, or in our case, the favorite we love to hate on all the time, is TVIX. And there's a lot of reasons why that one kind of went the way of the dodo. I encourage you to check out our Volatility Views program. We talked about it very recently during the market sell-off, how TVIX got scary from an overall AUM perspective, and it seemed like it was heading for a dire outcome. And I think Credit Suisse probably saw that as well. So they're delisting all of that effective, I think, July 12th. So that was already a big shakeup. And then now already, in just the dust-up of that, we already have new products from a startup that have been announced to potentially fill that void. Seems like they're getting some backing for the CBOE, so CBOE clearly wants another product to step into that void to drive some more futures volume and indeed maybe some latent VIX options volume as well. This is, of course, Volatility Shares. They're a startup that most recently got some headlines because they applied to launch a product called SVIX, which was intended to replace another product a lot of you liked, even though it blew up in 2018. That was XIV, which was, of course, an inverse VIX product. Lots of risks inherent in those. And now they've also dived into the fray yet again with a new product as well to replace TVIX. So just shortly after the death of that, I think within 24 hours, they announced this new product. I don't think we have a ticker on the new one yet, but it is an interesting one nonetheless. So they have a copycat already. This time going to tweak things a little bit. So one of the problems with TVIX is that it was an ETN, so it can get called away at any minute like it is right now. As a result, it was difficult to issue options on that new product going to be an ETF. So at the very least, it will be optionable. So a lot to unpack here for a lot of folks who watch the vol space. Maybe let's go back around the horn the way we just came. Maybe, Matt, we'll start with you because you live in the vol space. I'm curious, did you have the same somewhat pejorative thoughts that we had on TVIX? It was kind of the last of the Mohegans in the vol space, so people kept trading it despite the fact that it obviously had a lot of problems. Were you as kind of standoffish on it as we were? And then, B, what are your thoughts on it going the way of the dodo and then this new startup jumping into the fray to take its place and a shakeup of the vol space as a result, sir?
Yeah, I've always been very conservative on the symbols that I trade personally, and this is one of those that I mainly stayed away from. I have some clients that are very sophisticated that read all of the prospectus and know exactly like all the weaknesses and way more than anyone would care to know in a lifetime. And they have such an advantage, I thought, on me that if you're the old adage, if you're don't find the sucker at the poker table, it's probably you. Well, that's how I always felt about these types of things. And I always wonder, too, why they wouldn't put a little bit of a hedge on build that in, the Credit Suisse, that is. So what happened in the vol apocalypse wouldn't happen again. So, if they, wouldn't go negative or whatever happened. So I don't know. I mean, I stay away from those products. I'm sure Credit Suisse was still licking their wounds after February 2018 and tried to find a good way out. I like having the opportunity to have those types of ETNs, but it's very difficult to make them so it's just a level playing field where everyone can know the same amount about them, Mark.
Yeah, it's an interesting category, interesting space. There's so many rooms to play. Levered, inverse levered, all sorts of different flavors and permutations they're in. Oftentimes people get into these products without really understanding the nuances they're in, hence the blow up we saw with XIV a few years ago. Thankfully, we didn't really see that with TVIX. Probably was coming, though, which is probably why they decided to get the heck out of Dodge with this. Mr. Director of Risk, I'm curious your thoughts as well. Obviously, a huge shakeup. Even if you don't like the product, it still did a lot of paper out there, and it drove a lot of flow, and it touched a lot of other elements of the volatility space out there. What are your thoughts on these kind of, I wouldn't call them storied, but pretty popular products going the way of the dodo, and maybe the potential for these new startup products to jump right back into that void?
Well, you kind of said it. What I wanted to say is, ETNs and ETPs are issued to collect fees. The issuers are not creating these products because they're trying to better the investment landscape or the investment world. They are hedged. They are hedged internally against adverse movements in these products. But you're right. Retail people, other traders, investment managers that have not really looked at the prospectus and understand the nuances of the product, could be subject to that type of risk. So, I'm kind of in the same camp as Matt. Keep it simple. Don't go into these types of products because obviously, when the blow up happened, with XIV, what did they do to the other products? They changed the leverage, so they moved the goalposts. And that's not not a steady product that I want to be in. And additionally, I think Credit Suisse they did survive a lot of the lawsuits from XIV, and they just decided that they weren't going to do this again. And that's one of the reasons they just axed all these products because with the TVIX scare, because I remember there was a lot of talk on could TVIX be the next XIV, and I think they decided that, it's probably going to happen again in the future, and it's just going to be more egg on their face, and they decided to just can all of these products.
It's kind of hard to blame them. I mean, this was a bit of a ticking time bomb. I think you're right. A lot of people, including myself, still have a sour taste in their mouth from the neutering of SVXY and UVXY that occurred during the midst of that VIX-ocalypse back in 2018. Eric, if that's not enough of a shakeup for the vol ETP space and the vol market in general, I got another wrinkle, another iron to throw in the fire if you can handle it, Mr. Cott, which is, of course, CBOE saying that's not enough. We want to play more in the vol space, so they're going to revamp, rejigger their Treasury VIX. People might say, what? Treasury VIX? Yeah, there's a lot of flavors of VIX out there. You probably are only familiar with the granddaddy, the VIX index itself, but there's all sorts of VIXs out there. There was a crude oil VIX until not that long ago. That kind of blew up when crude went negative. It still hasn't resumed. There were Treasury VIXs. They tried single name VIX. All sorts of VIX flavors. Pick your poison. There's probably a flavor of VIX out there. Not a tradable product usually, but an index that is disseminated and calculated so you can at least see what's going on out there. If you're saying to yourself, I've always wanted a little bit more vol insight into the fixed income or treasury landscape. Well, CBOE's got you covered here. They had to delist their former product, a little bit of a spat with their crosstown friends over there, CME, and instead they're relisting their treasury VIX. It's going to come in 4 new flavors, and it's going to be based around TLT this time instead of the futures options over there at CME. It's also got some swaps baked into it, so a lot of interesting things afoot. So, Eric, huge shakeup in the vol space. Old school products going the way of the dodo, maybe new startups replacing them. And if that's not done, a new foray into the treasury vol side from CBOE. A lot to unpack here, sir. What are your thoughts?
Yeah, Mark, there's a lot to pay attention to. I mean, it changes a lot. And I think Chris really kind of hit the nail on the head, where for a lot of investors and folks that work with, advisors that work with their clients, it's keeping things simpler. And I think that's one of the issues. And it's just, some of the experience that I've had over the years, I think it's one of the things that has deterred advisors from using option strategies is because on the surface they look at it as very complicated. We start to get into the Greeks and such, but when you start to realize the value of it. But I also believe that in this fixed income side, we're all aware of what's going on right now, post-COVID, getting asset managers involved in, purchasing debt instruments. And I think there's a lot of moving parts. So without speculating on CBOE as the exchange and getting into this, I think that there are exchanges and asset managers and others, as Chris alluded to, that are looking for opportunities and opportunities where they could provide solutions to the investing public. So I think it's interesting at this time that these fixed income instruments, are being introduced. I also won't speculate as well about what's going on with Credit Suisse, but in the exchange, in the exchange traded fund industry, that all of us know about, it is most certainly there are, a lot that end up not making it through the year. Matt's well aware of that too. But then you get a lot of these firms that introduce, new, disciplines or new products. I mean, I will say that, Dimensional Funds was talking about recently that they were going to start offering some of these target dated ETFs. So, for the advisor, I sort of need to keep track of it. But there's a lot out there.
Speaking of a lot being out there, like I mentioned, the buzz is a different beast these days. We haven't even had a chance to get to the 800-pound gorilla, quite literally these days, in the advisor space. Since the last time we chatted here on this show, this on-again, off-again dance between Schwab and TD is very much on again. In fact, it's official. We've seen the DOJ clear the antitrust investigation pretty quickly. I think a lot of people were thinking that might get held up a little bit because it is a pretty sweeping change, particularly on the RIA side of the space. And yet the DOJ passing it there with flying colors, TD and Schwab both having their shareholder votes, both getting somewhere in the order of 99% of their shareholders voting to approve this thing. So it's pretty much a done deal. We've been talking about it for a while on our network from what impact it may have from an overall options trading perspective. And that's still unknown. TOS is a popular platform for a lot of the very active side of the retail options market. The Schwab legacy OX platform, not as much. They haven't done as much to integrate the OX the way the TD folks have done with the TOS platform. On the flip side, though, when it comes to advisors, Schwab has always been a giant in that space with a lot of assets under management. And now TD has been trying to get into that space with products like ThinkPipes and others. And maybe now those two coming together will make an interesting entity in and of itself. Eric, this is obviously a big story for a lot of those folks listening to this program right now. What are your thoughts here on this deal finally getting approved and what impact it could have for advisors and indeed options traders going forward, sir?
Well, it is a play on words, Mark, because you say, how is this going to impact advisors? That's what Schwab calls their conference that they do every year, which is the Schwab Impact Conference that takes place in the late third quarter. I'm not surprised that it got approved. I think what's going to be interesting is to see how this plays out for the registered investment advisement community, because early on, as I started, the two real option-centric firms that were offering, as you said, Mark, a lot of the technology and opportunities for advisors who were more option-centric, it was really Schwab and TD. You talk about the OXBX with Schwab, and then obviously TD with Thinkorswim and ThinkPipes, and the registered advisor community that is growing by leaps and bounds. How this will play out, it's hard to tell, but I think they're going to move, at least from what we heard last year, Mark, they're going to be moving headquarters from San Francisco, this is what we heard, to Texas, and how they integrate and things that will change in 2021, and where advisors who have been custodial agnostic, where they've had multiple custodians, how this will play out now that you remove, a bigger player and it becomes Schwab. But, again, the technology for both of those firms is phenomenal. And I really do believe that's why Schwab made that move and that acquisition.
All right, we're going to move right on into earnings. Earnings are kind of in the rearview mirror. It was an unprecedented season in just about any way you could think of it. I can't remember the last time I saw so many major Fortune 500 and indeed 100 firms coming out there and just kind of shrugging their shoulders, saying, we don't know. We have no idea what the future holds. We're withdrawing all guidance, and yet the stock still rallies. It's that kind of world we're in these days, listeners. And strangely enough, I think a lot of people thought this season was going to be a rock'em sock'em robot season from an overall volatility perspective. I thought names would really be pricing in a lot of juice And what we saw was kind of directly the opposite. We saw a lot of names pricing in less juice, and that turned out, go figure, to be the right trade. We saw overall the season kind of underperformed from a net volatility perspective. And who better to parse it all with than the keeper of the earnings volatility data, Mr. Matt, a.k.a. the earnings oracle of New Hampshire up there. Mr. Matt, first off, are you as surprised as I was that this last season was kind of so underwhelming? And B, that the people who were fading it were rewarded? I thought this was going to be a blow the doors off season, if ever there was one. And then do you have any other nuggets, maybe a look ahead to the next cycle, sir? Have at it.
Yeah, Mark, I talked about, this earnings coming in, and people are going to have to talk about how well they're doing. And really, they just avoided any guidance or anything, and the market really didn't punish them for it. So it just seemed like more and more of those firms did that. As far as the implied earnings move, it was very high, and we see it even coming up, and for this next earnings move, it quite high as well. So are they going to be able to sidestep it again? Who knows? But they're going to have to say something, and now. We're getting halfway through the year, and the implied earnings move is going to be up there again. And usually these option straddle holders are pretty correct. So I don't think they're going to be wrong twice, Mark. But it's going to be, I think, going to be wild. And again. The first couple of weeks aren't the wild weeks. We've seen that historically, and I've talked about that a few times here. It's the third, fourth, fifth week of the generally 6-week earnings season that are going to be very interesting. And as I was on this panel with one of the guys would listen to the earnings calls and judge how worried they were in their voice. And so the least worried person was Elon Musk, and the most worried, I think, was Johnson & Johnson. So I thought that was an interesting way to look at it, Mark.
Was Elon Musk in an altered state at the time, though? Because it may not count. It may skew the data a little bit.
Yeah, I mean, he would be my guest. As even if things were going down, he'd still be in a good mood. So who knows?
Let's see if the interest you guys have in all things options is going down, or as I suspect, up. We like to check in on the trends data we're seeing out of the big search engines. We do it usually at the beginning of the year and check in again middle of the year to see what's cooking. So it's around that time for a mid-year checkup on what's going on with the overall search levels of interest in options. Let's start at the most broad term and kind of narrow it down. First off, just your basic options. Who's searching for options out there? Well, again, this is going back 12 months, so it's the 1 year worth of data. Overall options search level at an all-time high. Google measures these on kind of a per capita range of interest, and so a 100 is the peak of the graph, and some number below that represents some proportional level of interest. A year ago, it was at about a 75%, so we're clearly higher than it was a year ago, and it even dipped into the 60s at one point. So now we're pretty much, that needle is pinned. We're right at 100 right now, which, again, is kind of confirmed by all the other anecdotal data we're seeing and hearing out of brokers and seeing on our network. Folks are very interested in options right now. Go figure. Let's dive down a little bit further, get into options trading. So options can involve other things that are perhaps not trading related. Options trading, very specific, and that one's off the charts as well. A year ago, that was only about a 25%. That compares to where we are right now. We buried the needle yet again just about a week or so ago. In fact, we're coming off of it a little bit. In fact, we're even higher than we were at the height of the sell-off in March. That came in on this graph. It looks like about an 80-odd% to about a 90. Hit the needle at 100 just about a week ago out there. So options trading interest also peaking, getting higher than it did during the sell-off in March, which is kind of interesting. I know the Rock Lobster has been very proud of the fact that Maine was the number one option search mecca for some time. No longer. It has surrendered that title. Their top 5 areas of interest now in the U.S. for option search: number 5, Minnesota; number 4, Colorado; number 3, Washington; number 2, Oregon; number 1, D.C. Again, I think sometimes the per capita nature of this maybe makes it easier for a handful of guys or gals in a certain area. Like I always blame the Rock Lobster for driving up Maine single-handedly. If you get options trading, it gets a little bit different. Number 5 is California, obviously a much bigger market. That's kind of interesting. Number 4, North Dakota, yet again. Number 3, New York. Number 2, Hawaii. Once again, number 1, D.C. So D.C. dominating the tape for options and options trading search interest these days, which a little surprising. Maybe all those senators and congressmen are trying to figure out what the heck to do to hedge their portfolios out there. If you're kind of wondering what other search terms come up related to options when you search for it, number 1 related topic is terrorism. I don't understand it. And then number 2 is market sentiment. So terrorism comes in above market sentiment. So people who search for options trading then now look for terrorism. I don't really know what to make of that. Read into that what you will, listeners. Get even more specific. Call option interest. Also, blowing the doors off. Was that 25% a year ago? Buried the needle again last week at 100. Just coming off that now. Looks like we're back in the high 80s or so out there right now. So call options interest, huge. If you want to know where the call love is, it's in Vermont. That's the number 1 spot people search for calls these days, is Vermont. If you want interest in puts and put options in particular, go figure when that interest peaked. Yeah, if you said the week of March 15th to 21st, you were exactly right. That's where that level dipped down, feels like in the teens about a year ago, and hit up at 100 in that March sell-off time frame, and then is now at about, looks like about a 60-odd%, so maybe, and dropping right now. So maybe that's a sign of the sentiment. Clearly, who needs puts when the market endlessly rallies? So maybe that's a sign. If you're wondering what the top of the interest level is for put options as well, yeah, it's DC yet again. Unfortunately, Matt, I don't see New Hampshire anywhere represented in these lists, sir. But what are your thoughts on all of this crazy data? And yet, once again, the needle getting pegged up there for options interest kind of across the board, even if most of it is in DC these days, Matt.
You're going to get me in trouble again, Mark. I got burned really bad on the 9/11 attacks, and now they're buying puts in DC. So it's a bad joke, but yeah, I mean, what we've seen is if my inbox is any indication, it's married to those, and unfortunately, we've seen some pretty tragic events of people not really understanding how options work. The unfortunate person that took his life at Robinhood. I read this blog on Elite Trader that the guy tried to figure out what was going on there, and it looked like he had an Amazon put spread and was assigned on the stock, and then even though he was going to probably make money on the trade, the account showed buying power of negative 700,000, but it didn't show the other long puts or what would have been protecting those. So it's a crazy time in the market, Mark, and I think those search terms point that out pretty well.
Yeah, I want to get to that Robinhood story. I don't think we'll have time for it today. We'll get to it on the next episode. If you want to hear a breakdown of it, listeners, in between, though, we did touch on it on a few other programs on the network, including Options Bootcamp and the Option Block. So you can sink your teeth into that. It's a very tragic story if you want to hear the underpinnings. I think it's worth explaining fully on this program as well, because a lot of the folks in this audience, including the advisors and certainly a lot of your clients, may not understand when they see an alert like that coming through their options accounts as well. Mr. Director of Risk, any thoughts here on what we're seeing from an overall options interest perspective and the dominance of DC, sir, out there in the options market these days?
Well, education is the key to success, so it's good that you're seeing areas around the country wanting to learn more about option trading, calls, puts, and different types of strategies. And that's why this show exists, and that's why the OIC exists, to be someone to lean on to explain, how these things work. There's been a tremendous amount of education over the last years. That's why, we started this show talking about volume. I would anticipate that volume is going to continue to increase. I would anticipate that these searches that you do are going to continue to increase, and then spread all over the world. Right? That's the ultimate goal, that everybody is able to manage their risk. They're able to enhance their portfolios. They're able to hedge when they need to, and manage their wealth and preserve their capital over full market cycles. I did want to mention real quick about the earnings thing. I think Q2 earnings was a big, nobody knows because of what was going on in the economy, with what the Fed was doing, with what the virus is doing, with all the bankruptcies that we're seeing. But I think that Q3 here, or at the end of Q2 now, rather, we're finally going to see these numbers. So I think it's going to be very interesting with the kind of data that Matt provides, down the road with what is the options market implying versus what is actually going to happen. Because I think we're coming off one quarter. I can't remember another quarter where it's kind of, I have to go back to the tech bubble where there was a period of we don't really know what's going on or what's about to happen. And I think this is very similar to that, where we don't know what earnings, the GFC was a little different because that was focused really, in the financial sector. This thing's not really hitting the financial sector. It's hitting mom and pop stores and stores and companies that we all shop at. And it's a different type of beast. And I think it's going to be very interesting to see what happens, through the option implied market when all these earnings start coming out, and the overall market in general.
Interesting to see what our listeners have in store for us as well. So let's squeeze into a real quick office hours.
It's time to answer your pressing questions about options. It's time to start our office hours. You can become a part of this segment by leaving a question on theoptionsinsider.com, emailing us at questions@theoptionsinsider.com, or via social media at twitter.com/options, facebook.com/theoptionsinsider, or stocktwits.com/optionsinsider.
All right, I think we're going to run a little long today because I want to squeeze a few of you folks in there. You're so patient writing into the show all the time, and make sure we get some of you on the show as well. First off, a quick one here from MTS. Mr. Cott, this is right up your alley. MTS, he or she wants to know, when is the next advisor options usage study coming from the council? I like that, just the council. That's what the cool kids call the OIC. I'm assuming they're referring to the Cerulli study here, Mr. Cott, but if you have any insight, feel free to share it with us, sir.
Well, I appreciate that listener sending that in. We are working on that as well as some other research that I can't really divulge right now. But your listeners will be the first to hear about this, Mark. Yes, we're about up at that time right now where we really need to delve into the DNA of advisors and do another one of those quant studies. And I'll just give a shout out to Chris because I thought he eloquently said, both Chris and Matt, and I really appreciate that, about the importance of education, which is why you do this show, Mark. So I just wanted to squeeze that in there.
An excellent squeezer, sir. Let's squeeze on in our next question here. This comes from Black with 2 L's and 2 K's. They want to know, does so many companies slashing their divvies impact the options market? Are you seeing less options volume as a result? Great program. Well, I think we answered the last portion of that question at the top of the show when we're saying it's pretty much never seen volume levels like this, Mr. or Mrs. Black. But the first part is kind of interesting. When I look at the impact of slashing dividends, I know who to turn to. It is the Oracle of New Hampshire up there, Mr. Matt from ORATS. Matt, you actually track how many firms are slashing their dividends. What are your thoughts here from Mr. and Mrs. Black? They want to know, how is this impacting the options market right now, sir?
Yeah, it's a great question. Not so much the liquidity, but what we would call, put-call parity. So what happens is you have a dividend assumption in every price of every option out there, whether it be zero or what the actual dividend is, or if the dividend is unknown, then there'll be an implied dividend that could be different from what's actually out there. And we have methods, it's very difficult, but we have methods to solve for that implied dividend. And once you start to solve for the implied dividend, it gets really interesting. For example, just a few days ago, the Fed said that they were going to start monitoring and regulating the dividends that banks could pay. And we immediately saw, about anywhere from 5% to 14% cuts in dividends that are implied in the marketplace. So the option market was all over that once that was known. And we've seen other things like Disney. They cut their Disney has a seasonality of their dividends in June and in December. We saw them cut their June, but the the option market thinks they're going to cut their December as well. So, great question by the listener. But where we see it is not necessarily in liquidity, but it's in the relationships between the calls and the puts. And we go ahead and then imply those, and we put those studies out. And you could always go to ORATS and check those out if you're interested, Mark.
Head on over there. ORATS.com is the place to go in between shows. If you want to kick the tires over there, check out the divs, the earnings studies, the back tester, all that good stuff. Unfortunately, that music means we come to the end of yet another epic show. Man, time flies when we're in the buzz, listeners. So much to talk about. Didn't even get to all the topics here. We'll get more on the next episode. Get more of your questions on as well, I promise. Matt, since we're talking ORATS, folks want to learn more. Maybe they want to kick the tires over there. What can they find when they head on over to ORATS.com?
And that's the fastest hour. I don't know if it's Eric's smooth voice along with your voice or the great stuff coming out of all your mouths and Chris's knowledge and everything, but wow, that went quick. Anyway, come on over to ORATS. We talked about dividends just now. We talked about earnings. We talked about SKU. We're back testing. We're releasing scanners. There's a plethora of things. So come on over. Hit me up, matt@orats.com. We're doing more consulting, helping people out with strategies, especially advisors nowadays. So look forward to hearing from all the great listeners out there, Mark.
All right, we have been hearing from them. Head on over to ORATS.com. Give them a follow on the old Twitters as well, @OptionRats. It's a memorable handle. You can't forget it. Almost as cool, dare I say it, as @Options. Not quite, but pretty cool out there nonetheless. Also cool, the title of Director of Risk, held by one Mr. Chris Hausman. Mr. Chris, if folks are intrigued, sounds like you're getting more fans out there for the Director of Risk. I think it's the cool title. People are sending you your own personal questions now. So if folks want to hit you up with questions in between shows, where should they go? And also, what can they find over there in Swan Land between episodes? Sure.
So, Matt will know what I'm about to say. Once upon a time, the risk manager at a desk was the most hated person. And I think what's happened is through education, risk is a real thing. So I didn't expect this to be a cool title, but I'm going to take it, especially from you guys. But anyways, this is hot off the presses, just released today. The dire outlook for bonds in the wake of COVID-19 by Mark Otto, one of our other portfolio managers here at SWAN. So this is basically a message we've been saying for quite some time now, that over the next decade or two, bonds are unlikely to fulfill their dual role of income and capital preservation. And so this could force bond investors to choose between income and capital preservation type strategies down the road. You can check that out at our website, swanglobalinvestments.com.
SwanGlobalInvestments.com. A lot of content for you guys to sink your teeth into there in between episodes. You used to be able to sign up for the 10th box events. Not so much for those, maybe for the virtual side, but you can get a lot of great content. There's the blog, there's the newsletter, links to a cool show called The Advisor's Option, maybe some fun stuff from the Director of Risk there. We shall see. So a lot of great content there for you guys to sink your teeth into in between episodes. Give them a follow on the old Twitter machine as well. @SwanGlobal is the place to find them. And last but not least, Mr. COTT, a.k.a. as the cool kids are calling it, the Council. What's coming on the pike from you guys over there at the Council these days, sir?
Well, thank you, Matt, for the smooth voice that you gave me. I really do appreciate that. But, from the optionseducation.org site, we'll let your listeners know that we have a new e-learning destination there. So I'm encouraging everybody all your listeners to come to optionseducation.org, to the 888 Options line. We have upcoming webinars also for July. And I would also just mention to you, Mark, and to Matt and Chris that wishing all three of you and your families a very happy and healthy Independence Day holiday coming up.
I appreciate that, sir. I echo that for all of you out there. I want to thank all of you on behalf of Mr. COTT from the Council, on behalf of the Director of Risk from Swan Global Investments, and from the Oracle of New Hampshire by way of Option Rats, by way of ORATS. And, of course, myself. I want to thank all of you out there for downloading, streaming, subscribing, for sending in questions, for listening live, all the fun stuff that you do. Keep it coming. Remember, if you like what you hear, keep those reviews coming to keep new folks continuing to discover the program. We love to see all the new earlobes joining us month after month. Stay safe, stay sane out there. And we'll see you back here next episode for more of The Advisor's Option.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.